some usual was due wellness stock again update in today's markets. The Fed will raise interest rates to a 22-year peak and retain its tendency to tighten again. So Fed policymakers are poised to raise interest rates to their highest level in 22 years, from 5.00% to 5.25% to 5.5%, when releasing its decision at 2 p.m. Washington time. And the Fed chairman Powell will hold a 30-minute press conference. Powell's speech will provide investors with clues as to how determined the central bank is to raise interest rates again in 2023. As inflationary pressures abated last month, investors expected an almost certain rate hike Wednesday but did not expect further hikes thereafter, with the FOMC expecting a final rate hike later this year in June. Veronica Clark, an economist at Citigroup, said they will keep all options open. They will certainly remain cautious after only a few months of weak inflation data, and they're not yet too convinced that the work of tightening is done. The Fed paused interest rate hikes in June, a move aimed at slowing the pace of rate hikes close to a level expected to be sufficient to limit inflation, which over time would return inflation to its 2% target. Still, Powell and other policymakers want to show firmness to avoid another spike in prices. Chief economist at Nationwide Life Insurance Corporation says they want to avoid the repeat of mistakes of the 1970s and the 80s when they released the brakes prematurely. The FOMC statement is likely to retain a paragraph of guidance suggesting or further tightening when Thursday's pre-GDP data was almost optimistic, and is likely to continue growth as modest. The committee may discuss whether to acknowledge the recent improvement in inflation or simply to say that inflation remains high. After the collapse of 3 U.S. banks, the Commission issued a statement of confidence in the banking sector, describing the sector as solid and resilient. Deutsche Bank economists said the committee may discuss whether to remove the paragraphs as the pressure eases. The IMF said there were upside risks to Japanese inflation and suggested that the Bank of Japan remain flexible and perhaps halt its yield curve control program. Advice to the Japanese authorities is that monetary policy can remain accommodative for now, but need to be prepared for the possibility of starting to tighten policy. IMF chief economist Pierre-Olivier Gouroncha said in Washington on Tuesday. The recommendation came just before the Bank of Japan will make a policy decision on Friday. The bank is widely expected to keep monetary policy unchanged, despite growing concern about the outlook for yield curve control. Companies such as Goldman Sachs and JP Morgan Chase & Co. are expected to adjust this week. While the IMF has been calling for monetary policy flexibility from the Bank of Japan for some time, Tuesday's latest statement appeared to have intensified than before. Our suggestion is to be more flexible and perhaps move towards stopping yield curve control, Gouroncha said. In its latest economic forecast released on Tuesday, the IMF expects Japan's economy to grow 1.4% this year before slowing to 1% in 2024. That's all we have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.